Forget what you think you know about Wall Street. That gut feeling, that whispering suspicion that the stock market is nothing more than a rigged game, a sophisticated scam designed to funnel money from the masses into the pockets of the elite. Here's the uncomfortable truth. The man who built the very first stock market also built the first stock market crash on purpose. And the trick he used 400 years ago is still legal today. This isn't some abstract economic theory. This is the bedrock of global capitalism, a system so deeply embedded in our lives that even if you've never bought a single share, you're already participating in it, whether you know it or not. The very notion that it could be. A scam is a powerful one, fueled by tales of Madoff-esque fraud, market crashes that devastate ordinary families, and the dizzying complexity that seems purpose-built to exclude outsiders. But how could something so seemingly predatory also be the greatest engine of human innovation and progress the world has ever seen? How can both truths coexist within the same colossal system? The answer lies not in a simple yes or number, but in an intricate dance of history, human psychology, and a mechanism born centuries ago that still shapes our tomorrow. Prepare to have your understanding of wealth, power, and the future fundamentally reshaped. To truly understand if the stock market is a scam, we have to journey back, not to the gilded cages of modern Wall Street, but to the muddy docks of 17th century Amsterdam. Imagine a time when sailing across oceans was a life-threatening gamble, a venture so impossibly expensive. That single merchant, not even a king, could bear the full cost and risk. That's where the Dutch East India Company enters the scene in 1602. They wanted to send massive fleets to Asia to bring back spices, silks, and treasures that promised unimaginable riches. But a single ship loaded with cargo could represent an entire fortune, vulnerable to storms, pirates, or rival navies. If it sank, everyone was ruined. So they invented a revolutionary solution, the concept of fractional ownership. Instead of one person funding an entire catastrophic voyage, hundreds of ordinary citizens, bakers, blacksmiths, even servants, could contribute a small amount of capital. In return, they received a piece of paper, a share, representing their tiny slice of ownership in the company and its future profits. If the fleet returned safely, everyone got their money back, plus a cut of the profits. If it didn't, the loss was distributed, not concentrated. But here's what most people never learn. Within 3 years of that first stock issuance, a Dutch trader named Isaac Lemaire, one of the company's own founding investors, organized the world's first recorded short-selling ring, secretly selling shares he didn't own, betting the price would collapse, and spreading rumors to make sure it did. The first stock market wasn't even a year old before someone had already figured out how to weaponize it. This simple invention birthed the modern stock market. A stock, at its core, is nothing more than a share of ownership in a company. When you buy McDonald's stock, you own a tiny piece of every Big Mac sold, every fry cooked, every golden arch shimmering across the globe. Why do companies like Apple or Tesla issue stock? Not as a favor to investors, but to raise capital. They need billions to build new factories, fund research into autonomous vehicles, develop the next iPhone, or expand into new markets. Instead of borrowing exclusively from banks and racking up massive debt, they sell slices of their future success to the public. They essentially say, give us your money now, and if we grow, you'll grow with us. The stock market, then, is simply the global marketplace where these slices of ownership are bought and sold. Buyers and sellers driven by hopes, fears, and predictions converge. Prices fluctuate based on supply and demand, company performance, economic news, even global events. It's a vast, intricate ecosystem, constantly breathing, constantly moving, fueled by the collective wisdom, and often the collective irrationality of millions. But here's where the narrative of scam begins to twist. Because while the core mechanism is elegantly simple, the human element introduces complexities that can feel downright predatory. This is where the illusion truly shatters, and we confront the paradox at the heart of the scam accusation. If the stock market is merely a logical mechanism for capital allocation, why do so many feel exploited? Part of the answer lies in the fundamental difference between investing and speculating. Investing in its purest form, is about long-term ownership, believing in the underlying value, and future growth of a company, much like those early Dutch citizens believed in their ships. Speculation, however, is about betting on short-term price movements, often driven by sentiment, technical analysis, or even pure gambling. When the market feels like a casino, it often is, but not because the market itself is rigged. It's because many players are treating it that way. Consider the efficient market hypothesis, a foundational economic idea, suggesting that all available information is already reflected in stock prices. If this were entirely true, consistently beating the market would be impossible, a fool's errand. And yet, one investor built a $100 billion fortune almost entirely by refusing to believe it. Warren Buffett has beaten the S&P 500's average annual return for over 50 consecutive years, not through algorithms or inside information, but by simply reading annual reports more carefully than anyone else was bothering to. This paradox reveals that while information tends to be priced in, human emotions, unforeseen events, and genuine analytical insight create constant opportunities for both gain and loss. The market isn't perfectly efficient. It's efficient enough to punish arrogance and reward patience. But here's the kicker. The real scam isn't the market itself, but often the misinformation, manipulation, and outright fraud that parasitizes it. Think of Bernie Madoff, whose infamous Ponzi scheme wasn't a flaw in the stock market's design, but a criminal exploiting trust within it. A scheme so audacious it ran for nearly 17 years, took in an estimated $65 billion, and fooled sophisticated banks before a single regulator caught it. Or consider pump and dump schemes, where unscrupulous actors artificially inflate the price of a penny stock through false rumors, only to sell their shares at a high, leaving others with worthless holdings. These are not the market failing. These are individuals failing the market. Even legitimate practices can feel predatory. High-frequency trading firms now execute trades in fractions of a millisecond, faster than a human eye can blink, creating volatility that seems to have number human logic at all. Short selling, where investors profit from a stock's decline, can feel like profiting from others' misfortune. Yet, these too are part of the markets, self-correcting mechanisms, providing liquidity, and often exposing overvalued companies. The perceived unfairness often stems from an informational asymmetry. Those with more data, faster access, and deeper understanding do have an advantage. This isn't a bug. It's a feature of any complex system. The system isn't rigged against you if you understand its rules, but it is designed to extract capital from the impatient, the emotional, and the uneducated. The stock market is not a scam. It is a tool, and like any powerful tool, it can be wielded for good, or it can be used to cause harm. The difference often lies with the wielder, not the tool itself. So, where does this leave us today? The stock market isn't some distant entity. It's woven into the fabric of your daily existence. Your 401, your pension plan, the mutual funds many hold, all invest heavily in the stock market. The unprecedented capital raised through public markets has fueled the development of companies like Tesla, which is pushing the boundaries of electric vehicles, and sustainable energy, and even SpaceX, which aims to colonize Mars. Without the stock market, these audacious ventures might never get off the ground. The quest to cure cancer, to develop new forms of renewable energy, to push the boundaries of human knowledge, all rely on vast pools of capital, often raised through the issuance of shares. Is the stock market a scam? Number. It's an incredibly powerful, deeply complex, and often brutally efficient mechanism for allocating capital driven by human ambition, fear, and innovation. It can be exploited, manipulated, and misunderstood, leading to devastating losses for the unwary. But at its core, it remains the most potent financial engine for progress humanity has ever devised. It's a tool capable of building empires, curing diseases, and funding our wildest dreams for the future. The scam isn't the market itself. It's the same trick Isaac Le Maire ran in 1609, just wearing a different suit. 400 years later, we still haven't closed the loophole he found in the market's very first year. So the real question isn't whether the game is rigged. It's whether you're finally ready to learn the rules. He was counting on you, never knowing.